Tensions escalate in the Persian Gulf as Iran claims responsibility for an attack on a U.S. warship. Meanwhile, stock markets react to mixed earnings reports and ongoing inflation concerns. Here are today's top 10 stories you need to know. Inflation continues to be a primary concern for economists and policymakers as recent data shows elevated price levels across various sectors. The Consumer Price Index indicates that inflation remains above target levels, primarily driven by rising energy costs and supply chain disruptions. This persistent inflation is prompting discussions on potential policy responses and the need for proactive measures. As consumers feel the pinch at the pump and in their everyday purchases, the pressure is mounting on policymakers to address the situation. The Federal Reserve's decisions in the coming months will be critical in shaping the economic landscape as they weigh the balance between supporting growth and controlling inflation. Moving forward, the potential for inflation to impact consumer behavior and overall economic stability will remain a key focus for stakeholders. Economic growth projections are being adjusted as analysts react to ongoing inflationary pressures and geopolitical uncertainties. Recent data indicates that growth may not reach previous forecasts due to persistent inflation and rising interest rates. This situation is exacerbated by global events, including supply chain disruptions and geopolitical tensions that have created an unpredictable economic environment. As a result, economists are reevaluating their models, leading to a more cautious outlook. This adjustment is crucial for policymakers who must balance the need to stimulate growth while controlling inflation. The broader economic landscape remains fragile, with potential risks that could derail recovery efforts. Stakeholders must remain vigilant as they navigate these shifting dynamics. The adjustments made now will have significant implications for future economic policies, and a focus on innovation and resilience will be essential in fostering sustainable growth moving forward. International relations are at a critical juncture as nations assess their positions amid rising geopolitical tensions, particularly due to the ongoing conflict in Iran. This situation has reignited discussions surrounding global alliances and security strategies, with countries reevaluating their foreign policies in light of perceived threats. The evolving dynamics have led to shifts in diplomatic relations as nations seek to bolster their security and economic interests. Analysts warn that maintaining stability in international relations is crucial for fostering economic growth and addressing pressing global challenges like climate change and public health crises. The implications of these developments extend far beyond immediate security concerns, influencing trade agreements and international economic partnerships. As nations navigate this complex landscape, the importance of diplomacy and effective communication cannot be overstated. Looking ahead, the coming months will be pivotal, as the choices made now will significantly shape the future of global cooperation and regional stability. Global supply chain disruptions continue to pose significant challenges for businesses worldwide. The ripple effects of the COVID-19 pandemic, coupled with rising geopolitical tensions, have resulted in persistent delays and shortages in critical materials across various sectors. The automotive and electronics industries, in particular, have been severely impacted, struggling to meet consumer demand. Analysts caution that these ongoing disruptions could stifle economic recovery efforts and exacerbate inflation rates, which are already at multi-decade highs. Companies are facing increased operational costs as they scramble to adapt to this unpredictable landscape, leading to higher prices for consumers and squeezed profit margins. This situation is prompting a reevaluation of supply chain strategies, emphasizing the need for diversification and resilience. As businesses confront these challenges, many are investing in technology and alternative suppliers to mitigate risks. Looking ahead, the focus will likely shift towards building more robust supply chains that can withstand future shocks, ensuring greater stability in global trade and economic growth. Tech giants continue to play a pivotal role in market performance, as recent earnings reports reveal robust growth across the sector. Companies like Microsoft and Apple have reported better than expected quarterly results, fueling optimism among investors and analysts alike. The tech sector has emerged as a critical driver of economic recovery, particularly as demand for digital services and products remains strong amidst ongoing global shifts toward remote work and online activities. However, challenges such as supply chain disruptions, semiconductor shortages, and rising inflation are prompting caution among market experts. The recent earnings season has demonstrated that while tech companies are thriving, they are also navigating a complex landscape filled with uncertainties that could impact future performance. Investors are closely monitoring these developments as the performance of tech stocks often sets the tone for broader market movements. Moving forward, attention will be focused on how these companies adapt to ongoing challenges while striving to maintain their impressive growth trajectories in an evolving economic landscape. The job market is facing significant challenges as companies announce layoffs related to artificial intelligence advancements. Major corporations are restructuring their workforce in response to the increased efficiency brought by AI technologies. Reports indicate that many positions are being eliminated as companies pivot towards automation and digital solutions. This trend raises concerns about job security for workers in various sectors, particularly in industries that are heavily reliant on traditional labor. Economists suggest that the rapid adoption of AI could lead to a mismatch in labor demand and available skills in the workforce. As businesses continue to embrace technological advancements, policymakers are urged to consider strategies to address potential job displacement. The implications for the economy are profound, as reduced employment could lead to decreased consumer spending and economic growth. As this trend evolves, stakeholders will need to engage in discussions on how to support affected workers and mitigate long-term impacts. Oil prices have surged recently amid increasing market turmoil driven by geopolitical tensions and supply concerns. The ongoing conflict in Iran has raised fears of disruptions in oil supply from the region, prompting investors to seek safe havens in crude oil. These developments have caused oil prices to jump significantly, impacting global markets and fueling inflationary pressures. Historically, such spikes in oil prices have often correlated with geopolitical instability, reminding many of past crises that led to economic downturns. Analysts suggest that the current climate may lead to further price increases if the situation escalates, particularly if sanctions are imposed or production is hindered. The surge in oil prices is creating ripple effects across various sectors, with industries reliant on fossil fuels feeling the strain of increased costs. Economists warn that sustained high oil prices could exacerbate existing economic challenges, potentially leading to a decrease in consumer spending and lower corporate profits. Looking ahead, market participants will need to prepare for potential volatility as the energy market remains a critical barometer for inflation and economic growth. In a recent meeting, the Federal Reserve has decided to maintain interest rates steady amid ongoing economic uncertainty. The decision comes as inflation remains elevated, driven by rising energy costs. The central bank's target range for the federal funds rate remains between 3.5% and 3.75%, reflecting a cautious approach given the economic landscape. This marks the third consecutive meeting where rates have been held steady, indicating the Fed's strategy to navigate inflation while supporting economic growth. Analysts note that the decision reflects concerns over job gains and a relatively unchanged unemployment rate amidst rising inflation. The Fed's cautious stance is seen as a response to the complexities posed by geopolitical tensions, particularly the conflict in Iran. As inflationary pressures persist, the Fed may face increasing scrutiny from policymakers and market participants. Future meetings will be critical as the Fed evaluates the impact of ongoing events and economic data. Investors will be closely watching for any signals regarding potential rate changes in response to evolving economic conditions. On May 5, 2026, stock markets experienced significant volatility as investors reacted to a series of mixed earnings reports from major companies. The S&P 500 and Nasdaq Composite indices showed signs of retreat following a week of record highs, primarily influenced by ongoing geopolitical tensions, particularly the conflict in Iran. While several tech giants reported earnings that exceeded analysts' expectations, Concerns over rising inflation and international instability dampened overall market sentiment. Notably, Berkshire Hathaway and GameStop attracted attention, with analysts speculating on their future performance amid this turbulent market landscape. Historically, earnings season often serves as a bellwether for economic health, but the current interplay between corporate performance and global conflicts raises new uncertainties. Economists warn that this dynamic could lead to increased market fluctuations in the coming weeks, as investors grapple with conflicting signals. Furthermore, the Federal Reserve's forthcoming decisions in response to persistent inflationary pressures will be critical in shaping market dynamics. As earnings season progresses, market watchers will closely monitor how companies adapt to these challenges. The focus will also be on whether corporate strategies can mitigate the impacts of geopolitical risks and inflation, setting the stage for future market recovery. In a significant escalation of tensions in the Persian Gulf, Iranian officials have claimed responsibility for an attack on a U.S. warship. This incident, which involved missile strikes, marks a pivotal moment in ongoing hostilities between the two nations and exacerbates fears of a wider conflict in the region. The U.S. Navy reported damage to the warship, although no casualties were reported. Iran's actions are widely interpreted as a direct response to the intensifying U.S. sanctions and military maneuvers aimed at curbing its influence. The geopolitical implications are vast, as rising oil prices and market instability could follow this confrontation, affecting economies worldwide. Analysts believe this aggressive act could compel the U.S. to increase its military presence in the area, further heightening tensions. The U.S. government has condemned the attack and vowed to respond decisively, keeping military and diplomatic options on the table. Regional allies of the U.S. may also be drawn into the fray, complicating an already volatile situation. Investors and policymakers are closely monitoring developments, as the consequences of this incident could ripple through global markets and impact energy supplies. In the coming days, the international community will be keenly observing how both nations navigate this escalated standoff and whether diplomatic channels can be effectively utilized to de-escalate tensions. Thank you for watching today's top stories. Which news item surprised you the most? Let us know in the comments, and don't forget to like and subscribe for more updates.